Today's cardinal lesson, we're talking about estate planning and what some would call the return of the estate tax. And, it's not coming back for everyone, but the thresholds are coming way down, possibly. So you say, well, I don't typically start talking about laws that haven't been enacted yet, but I'm making an exception in this case because I'm getting so many questions from my clients and the incoming clients that are reading about this business of funding the Build Back Better Act, which is right now in the end of 2021, it's either going to become law or it's not. And they're negotiating that right now. This is not a political, I don't get on sides of that. My job is not to do that. My job is to do the best for my clients and showing them what their options are to better things for them and their family. And so what I want to do with this is just talk about it and explain, like, if it passes, what are the ramifications of that? So the Build Back Better Act is the infrastructure bill. And I think what's going on with the estate tax and estate planning, I think that most of the people negotiating the bill, they don't even completely understand this, and you don't really hear a lot of it. You got to look hard for it. And what they're doing is they're making the estate tax is going to generate additional revenue to pay for the spending. And so they're getting that by drastically lowering the exemption, and they may do more of this in the future. And secondly, if this doesn't pass, if it doesn't become law, this isn't going away. I mean, this is, if you go into the deep inside of Congress and the Congressional Budget Office and how they write bills, the people that do that go to the IRS and to the Treasury Department, and they calculate, okay, so if you raise taxes in this way by this amount, how much revenue is that going to collect? And they actually, when they're spending money on new legislation, they have to create the money to pay for it. And this is one of the ways that that's happening. And it's likely enough, and I'm getting enough questions about it, what's covered in the press, that's what today's cardinal lesson is about. Okay, so first of all, it's not yet passed. And one thing that's on the track, or it's on the slate, that people don't really know of is this whole business of grantor trusts, or, this is an industry abbreviation, an ILIT, which is an individual life insurance trust. And it's a trust that is specifically designed to hold a life insurance policy. Now you say, well, boy, how many people have one of those? Well, you'd be surprised, because it is a way, if you purchase life insurance and you own it and then you pass away, the death benefit, or the money coming out of the life insurance policy, it's not going to be taxed with income tax. It's going to come tax-free to the beneficiary, income tax-free. But if you own the policy yourself, it's going to be included in your estate. So a lot of people buy life insurance over the years and have bought life insurance to pay the estate taxes. So they own this separate life insurance policy, and when they die, they've got all their assets over here, and they've got a certain amount of estate taxes that they're going to need to pay on this estate, or their heirs are going to need to pay, and the estate's going to pay. So they own this life insurance over here, which comes tax-free to the beneficiary, and it is designed to pay the estate tax in many cases. The problem comes in if you also own this life insurance, the value of it gets included in your estate. So it makes the estate even larger and creates more taxes. That's one of the reasons the ILIT was created, or the Individual Life Insurance Trust. And so this new Build Back Better Act is going to put some real restrictions on ILITs. So the ones that are in place are grandfathered, but they have very soft grandfather provisions, or very In other words, it's going to be pretty easy if you add any money, the way the legislation stands now, if you add any money to the trust after the 1st of January 2022, like gift money in there to pay the premiums on the life insurance, that policy or that trust could be clawed back into the estate. If you set up any new grantor trusts or individual life insurance trusts after 1/1/2022, and you do that, then even if the trust owns the life insurance policy, when you subsequently die, the whole value of the life insurance policies inside of that trust are going to be clawed back and counted in the size of your estate. So, we'll talk in just a sec about what you do. Life insurance is what's owned inside of the trust, and most people want their life insurance money to just go to their heirs, and they want them to be able to get that income tax free and estate tax free. And even when they eliminate these grantor trusts, or if you have one now, I can assure you there's going to be ways to set things up so you don't own the policy and it won't be included in your estate. So you're still going to be able to buy life insurance and use it for the same purposes. They're just going through what they're seeing as a lot of advanced planning strategies or tax dodges done by wealthy people. They're just plugging all the holes so they can collect the revenue. And, my thinking is people will come up with more ways to get around some of these things, or just a plan for people. Now, the biggest effect of this thing is really going to be on the family farms and small businesses, okay? And that's the area that they really raise these estate tax exemption amounts, or in other words, they made the estate tax go away over the years for people that had family farms and small businesses, because previously, back when I started doing this, I started way before this, but I'm going back to my early days of doing financial planning. This estate tax exemption was $600,000, and that's per person. So if you had a husband and wife, it was $600,000 on him and $600,000 on her. But people that had that much money typically gave all the money to the surviving spouse because they needed to, and then there were trouble. So this was what the exemption was, and you can see over the years, this thing has gone up and it's gone up, and by 2011, it was at 5 million. What was 600,000 14 years earlier had gotten to 5 million, and then in 2017, because of inflation, the 5 million had become 5,490,000. And then in the new tax law, which was just a few years ago in 2018, this exemption amount went up to its current levels of, $11,700. It was a little bit less than that. It's had a little inflation put on it. But that's quite a big jump from 600,000 in just what is 25 years. And so a lot of people have just dismissed this whole subject, possibly even me included, when I had a perception that it was going to be at this levels, because frankly, there aren't that many people that fall into this category. So, you just start thinking, well, I haven't abandoned estate planning, or I hadn't abandoned estate planning, because estate planning and what happens to your money after you pass away is important to people that have $100,000 or $200,000. It's just as important or more important to them than it is with people that have 10 or 20 million or more. The estate tax has just, over the years, they've raised the exemption amount just to make it so that it excludes people that own these smaller businesses, or they own a farm and the farm is worth a few $1,000,000, and they'd have stories of people that had to sell the farm to pay the estate taxes, or it put such a burden borrowing on that. Is the government really doesn't want to confiscate these smaller businesses or you could call it a business worth like 10 million. Maybe it's not a small business, but you'd be surprised how many of these that exist. So the whole idea behind having these higher exemption amounts was to just exclude those people so they didn't have to worry about this and they didn't have to do planning. Now, the way at the foundation of a lot of the planning was life insurance. And then life insurance set up in a trust to keep it outside the estate so that at least you had some money sitting here that would come from the insurance company to pay the estate taxes so the people could keep the farm. So now the new legislation is going to go back and claw into those things and really just create of raising revenue for the government. Now, what's going to happen if this thing passes is what was 11,700,000 is going to come down to 6,020,000. You could say, well, this isn't me. This stuff doesn't really even, why am I watching this video? Well, for many people it's not, but there's still some stuff in here that affects ordinary people. Like part of the legislation is to eliminate the step up in basis. And then they've talked about different thresholds for that. But essentially what a step up in basis is, we did an earlier video on this on YouTube of what it is. So I'd refer you to that video if you wanted to get a detailed explanation of that. But essentially, when a person passes away, the basis for the heirs in a piece of property or any capital asset is going to become what its value was on the date of death. So it actually allows you to sell assets after death and not have to pay income taxes on the gains. So I have a client who's a widow lady that, she's definitely not a millionaire, but after her relatives bought this property from her that I helped negotiate, they paid her $400,000 for the property for a piece of the farm that belonged to her deceased husband. And what she was so worried about, and I was concerned about too, is if the grandfather who owned the property, it was $100,000 an acre or 4 acres, $400,000. If he had only paid, $1,000 an acre or something, I was just concerned that she was going to have to pay income taxes on a big portion of this $400,000. But we were able to really come up with a stepped up basis at the date that her husband died, and we were able actually to pay no taxes on that. So where this is an issue is for very middle class families is if you have a piece of property, a home, a little piece of a farm, some piece of commercial real estate, or just something, you own some stock in a company that you've held for years, and it's worth a whole lot more at your death than it was when you bought it. Under the existing law, your heirs are going to get a stepped up basis, so that at least they're not going to have to pay income taxes on that. And there's some proposals in this that are going to get rid of this step up in basis. The other place that estate planning and taxation is very concerning is in the area of IRAs, because if you have a taxable IRA and you die, no taxes have been paid on that money, and if your heirs are going to get any money out of that, which they're forced to do, they're going to have to pay income taxes. So there's a lot of things floating around estate planning, the estate tax, how all this works, and I just wanted to go over that a bit and saying there's a big reduction in this thing. They're going to be eliminating grantor trusts possibly, and you're still going to be able to buy life insurance. It's just we're going to need to set up the ownership of that very carefully so that you're not deemed to have owned the policy when you die. I think we're still going to be able to do that after this. Some people that are very concerned that are in these categories, there's some things we can do anticipating the passing of this and sharpen up that could possibly improve the situation for your family as well. So I just want to stress, I want to talk about it a little bit. I'm Hans Scheil, and I thank you for listening.